We've looked at inflation numbers, not only numbers that came yesterday, but how much they've traversed from their highs. You must remember that we have done our rate hikes, last rate hike in October 2011, when headline inflation was around 10% and core inflation was above 8%. So we have to recognize that there has been significant drop both in the headline and in the core inflation. And we also have said that over the last 1.5 years, our bias has shifted from inflation to growth inflation balance and now towards growth. We looked at the growth numbers and they'd slipped from 7.7% first quarter, 6.9% second quarter, 6.1% third quarter. So I don't believe that we've changed our response function and that we've acted in our best professional judgment. I'm not ruling out either a rate hike or a further rate reduction. We just give guidance that based on our current understanding of how growth and inflation might roll out, and given that the trend growth rate is around 7.5%, so we said that the scope for further rate action is limited. But should the government adjust the prices, subsidize prices, should the external situation be better than we anticipate? I believe that there is scope for further easing. You know, the core inflation, which is a function of demand conditions in the economy, that had come down below 5%. The number yesterday was 4.7%. Now, there is inflation stemming from supply side shocks. In fact, food inflation yesterday had gone up substantially. And we heard Finance Minister say today that government is going to take action. Has taken a lot of action, might take further action. So it's not a question of apportioning blame, but I think it's a question of sharing responsibility. I believe so. In fact, one of the considerations between a milder policy rate action and what you consider more decisive action is the impact it might have on transmission. We wanted to send a stronger signal, and we found that the inflation print yesterday and the growth deterioration over the last 1 year indeed support a stronger action. So both based on growth inflation dynamics as well as the need to send a strong signal about monetary transmission, we decided on a bigger reduction. Our expectation is that for a number of reasons, including the bigger reduction, 50 basis points, transmission would be effective. In fact, there is a statement as all the time in all of our policy reviews, you would see that statement about the effectiveness of monetary transmission, how much it is translating into base rate. I don't believe so. Last year, we had extraordinary circumstances. Government had raised its borrowing in the second half of the year. We had to intervene in the foreign exchange market. So, and government cash balances built up in a lumpy manner more often than in the past. All these variables had made liquidity management more challenging than in a normal year. We're hoping that those circumstances will not repeat this year.